So good morning or good afternoon, dear ladies and gentlemen. It is my sincere pleasure to welcome you to today's webinar. We hope that we will find you all very well throughout these turbulent times. In October 2021, more than 135 jurisdictions agreed on a plan to update key elements of the international tax regulations in order to provide a suitable background for the demands of a globalized and digitalized economy. The Global Anti-Base Erosion Rules, or GLOBE for short, are a key component of this plan and our topic today. In the course of this webinar, my dear colleagues Priya, Selvanathan and Prabu Chaloraju will provide you with a sound understanding of BEPS Pillar 2 and Malaysia's position in this regard. They will point out the potential impact on your cross-border business ventures and add some practical hands-on guidance on how to cope with this impact in the future. Though we probably all had our fair share of digital meetings in the meantime, let me quickly guide you through the technical side. In the top right corner of your screen, you will find the control panel. Here you may adjust the audio settings and choose between your computer audio or your headset if available. Please note that as an attendee, you are muted by default. A little further down on the dashboard, you will find the question panel. Please insert all your questions or comments here for us to take care of. You may do so anytime during the session and also refer, of course, to topical questions, but also to any technical hiccups that might occur. We will, of course, take immediate care of the latter and be happy to take down your topical questions to refer to these later on in our Q&A session at the end of this webinar. Please note that this webinar is recorded and will be made available for you or your colleagues to recap anytime later on if you wish. So, looking forward to a most enlightening session. It will now be my pleasure to leave the stage to Prabu. Prabu, the stage is yours.
Thank you, Bettina. So hello, everyone. My name is Prabu Chaloraju. I'm a senior tax consultant with Rödl, and I'll be hosting today's webinar with my colleague Priya, who's also the head of tax and transfer pricing. So today's webinar is about the widely discussed topic in the international tax landscape. It's BEPS, that is base erosion and profit shifting. Our webinar today will focus on particularly BEPS Pillar 2. The key takeaway for today's webinar is to first create the awareness on what Pillar 2 is all about. We will not go through the nitty-gritty details as Malaysia has yet to provide guidance on how Pillar 2 will take effect and operate together with the existing domestic tax laws. But we will discuss the various considerations businesses now have to deliberate with Pillar 2 in the horizon, because Pillar 2 is generally accepted as the way to go by most jurisdictions and will likely to be rolled out in very near future. And so the agenda, we will run through first, as I said, what is BEPS Pillar 2 all about, and next we will explain the stand which Malaysia took with regards to the international tax standard. Thereafter, we will take you through some case studies for a practical understanding of how Pillar 2 is going to operate. Finally, we will discuss the impact on businesses as a result of Pillar 2 and the next steps that you need to consider moving forward. Next slide. So before I jump into the Pillar 2 itself, just a little bit of history. It all started in 2013. The BEPS project was launched by the OECD and G20 countries. The OECD is the Organization for Economic Cooperation and Development. The OECD is an intergovernmental economic organization with 38 member countries to stimulate economic progress and world trade. The G20 or Group of 20 is an intergovernmental group of countries comprising of 19 countries and the EU, European Union. The G20 addresses major issues related to the global economy, such as international financial stability, including tax, climate change mitigation, and sustainable development. So back to BEPS. Significant work has been done to address behavior by multinational corporations that can result in low rates of taxes paid. More specifically, businesses that operate in more than one country are often able to optimize their tax burden by shifting profits from high tax jurisdictions to low tax jurisdictions. This profit shifting behavior can have an impact on a country's tax revenues. To mitigate this, the OECD and G20 published 15 action plans to eliminate base erosion and profit shifting activities. The OECD and G20 have continued to undertake further work on many of the BEPS action plans through the BEPS Inclusive Framework. The Inclusive Framework brings together a much larger group of countries than those involved in agreeing to the recommendation published back in 2015, enabling additional countries to take part in the ongoing BEPS work on an equal footing with the OECD member countries and the G20 countries, provided they commit to the BEPS minimum standards. So that is how Malaysia becomes relevant here, because Malaysia is an associate to the BEPS Inclusive Framework and has committed to implement 4 standards, and they are countering harmful tax practices, that is BEPS Action 5, preventing of treaty abuse, BEPS Action 6, implementation of country-by-country reporting, that's BEPS Action 13, and enhancing dispute resolution mechanisms, that's BEPS Action 14. So as part of this, the BEPS IF has agreed a 2-pillar solution to address the tax challenges arising from the digitalization of the economy. Before Pillar 2, there's a Pillar 1. The Pillar 1 is the reallocation of certain profits from very large multinational enterprises, MNEs, to market jurisdictions aimed to accommodate changes in business models arising from the digitalization of the economy. This applies to MNEs with turnover over euro 20 billion and profitability above 10%. So subsequent to Pillar 1, following an agreement in October 2021 of 137 countries agreed out of 141 IF members, the OECD announced in December 2021 that the Pillar 2 model rules that were based on the Pillar 2 blueprint published in October 2020 is approved. So Pillar 2 is about the global minimum tax, mainly to address the issues of big corporations that take advantage of low to no income tax jurisdictions by implementing a global minimum tax rate. Next slide, please.
I'm sorry, here we go with a technical hiccup, but obviously it works now.
Okay, so BEPS Pillar 2 set a global minimum tax at 15% for multinational enterprises with a turnover of more than euro 750 million, regardless of whether where they are headquartered or operate. The aim of Pillar 2 is first to reduce the incentives for MNEs to shift group profits to low tax countries, and second, to ensure that large internationally operating businesses pay a minimum level of tax of 15%, regardless of where they are headquartered or operate. So, and OECD aims to start implementing the BEPS Pillar 2 by 2023. Next slide, please. So these are the entities that will be exposed to BEPS Pillar 2, where the scope of Pillar 2 applies. As I mentioned before, it will be the MNE groups that have an annual consolidated revenue of at least euro 750 million in at least 2 of the last 4 years. An MNE group means any group that includes at least one entity or permanent establishment that is not located in the jurisdiction of the ultimate parent entity, and the entities that are not excluded entities. Those entities that are classified as excluded entities will not be exposed to BEPS Pillar 2. So the excluded entities are governmental entity, an international organization, non-profit organization, pension fund, investment fund that is an ultimate parent entity, or a real estate investment vehicle that is an ultimate parent entity. So these companies will not be exposed to BEPS Pillar 2, even though the company's annual revenue exceed the 750 million euro threshold. Next slide, please. So over here, we are going to discuss how the effective tax rate will be computed. We should first start with identifying the M&E groups within the scope of the GLOBE rules, which is the Pillar 2 rules. The Euro 750 million consolidated revenue test would apply. The M&E groups are in scope if the revenue in the consolidated financial statements exceed this threshold amount. The test is based on the 2 of the 4 fiscal years immediately preceding the tested fiscal year. There are special rules to set out or to address the effect of mergers or demergers. However, we will not go through those rules here. Next, we determine the constituent entities. Constituent entities are those group entities that are subject to the operative provision of the GLOBE rules. That means in the previous slide, we have discussed those criteria, at an entity level, those entity that would be subject to Pillar 2. The constituent entity, the term comprises of all entities included in a group, including the permanent establishment. So any PE that is a constituent entity is treated as a separate entity from the main entity. So in this process, we should also remove any excluded entities that could be a real estate vehicle or investment fund. And then next, we should consider preparing the GLOBE income or loss. The entity's GLOBE income is the net income or loss that is used for preparing consolidated financial statements of the ultimate parent entity prior to the elimination of intra-group items. And next, you identify the taxes attributable to the GLOBE income or loss for each constituent entity, the so-called covered taxes. Where the effective tax rate is at or above 15%, no further work needs to be done. Where the ETR is below 15%, there will be a need to increase the tax rate to achieve the minimum tax rate, which is the 15% tax. In other words, a top-up tax is payable to the relevant local jurisdiction. Next slide, please. So this is how the computation of the effective tax rate would look like. The starting point is to gather the income, which is the net income or loss that is used to prepare the consolidated financial statements of the ultimate parent company prior to the elimination of the intra-group items. Then we need to adjust for the financial accounting net income or loss to GLOBE base. The net income or loss determined under the net income or loss that is determined is then adjusted to eliminate a number of common book to tax differences, where that adjustment is justified on policy grounds. So the adjustments are such as dividends, equity gain or loss, policy disallowed expenses, something like illegal payments or penalties, stock-based compensation, foreign currency gains and losses. Also, international shipping income will be excluded. Where there is a PE, GLOBE income or loss is allocated between a PE and the main entity in accordance with the local tax treatment. These allocation rules ensure an appropriate allocation of financial net income or loss between these entities and their PE, because PE is treated as a separate entity for Pillar 2 purpose. Next slide, please. So the adjusted covered tax here will be equal to the current tax expense accrued in the statement of profit or loss, SOPL. However, adjustment needs to be made. The adjustment will be the net amount of addition or reductions to covered taxes, as well as the total deferred tax adjustment amount. And also, we have to factor any increase or decrease in covered taxes recorded in equity or other comprehensive income relating to the globe income or loss, which is subject to the local tax rules. There are further details on additions and reductions to covered taxes of a constituent entity. However, we will not go into such details for today. When we refer to covered taxes means the four categories of taxes. Taxes that are recorded in the financial accounts of a constituent entity with respect to its income or profits, or its share of the income or profits of a constituent entity in which it owns an ownership interest. Taxes on distributed profits, deemed profit distributions, and non-business expenses imposed under an eligible distribution tax system, and also taxes imposed in lieu of a generally applicable corporate income tax, taxes levied for reference to retained earnings and corporate equity, including a tax on multiple components based on income and equity. There is a need to allocate the amount of covered taxes appropriately. Specific rules are provided for the allocation of covered taxes from one constituent entity to another in order to match such taxes to the globe income or loss to which they relate. Covered taxes of a PE are allocated to the PE. Covered taxes of a constituent entity that is an owner of a tax transparent entity are allocated to the constituent entity owner. Covered taxes under a controlled, CFC, a controlled foreign company tax regime, are allocated to the CFC. In the case of a constituent entity that is a hybrid entity, covered taxes of the constituent entity owner on income of the constituent entity under the fiscal transparency rule are allocated to the hybrid entity. Covered taxes of a constituent entity's direct constituent entity owners on distributions from the constituent entity are allocated to the distributing constituent entity. Next slide, please. So this is how the globe income, the computation of effective tax rate will be undertaken after determining the globe income or loss. And in this case, for instance, we have 790 million, which is above the 750 million threshold. Your covered taxes are allocated appropriately after making the adjustment, which is 200 million. So your effective tax rate here would be above 15%, that would be 25%. Therefore, there is no further work done. There is the Pillar 2 considerations are met here. Next slide, please. Over here, you can see the globe income or loss, 790 million euros, which is above the threshold, so it applies over here. And the covered taxes after adjustment will be is 80 million. So therefore, the effective tax rate computed will be 10%, which is below the minimum tax rate required under Pillar 2, which is 15%. Therefore, a top-up tax is required. That will be 15 minus 10, 5%. The 5% top-up tax will be remitted to the local jurisdiction. Next slide, please. So where does Malaysia stand? Malaysia, in principle, has committed to implement and to adhere to the international tax standard. The Malaysian tax authorities has released a press statement in 2016 confirming that the MIRB, the Malaysian tax authorities, will review tax regulations to align with BEPS 2 direction. Malaysia officially joined the OECD Inclusive Framework, as mentioned before, as an associate member. The tax authority also has set up a BEPS action committee to discuss findings from the BEPS meetings, consider potential follow-up actions, and potentially make recommendations to the government for legislative amendments. In line with all this, the tax authorities has increased transfer pricing related audits. There are also significant changes in recent years made to the Malaysia TP guidelines to be in line with the BEPS recommendation for CBC reporting particularly. Next slide, please. Other than that, the tax incentive framework is also currently being finalized to make Malaysia an attractive investment country. The incentives framework is expected to finalize this year. That would also be in line with BEPS Pillar 2. Also, by removing this foreign source income exemption with the recent change, the foreign source income received by residents in Malaysia will be exposed to income tax at the prevailing tax rate. With this change, the Malaysian tax system has changed from a territorial tax system to quasi-territorial tax system. So the timing of all these changes are coinciding with BEPS 2.0 Pillar 2 project, which is going to be starting on January 1st, 2023. Therefore, we expect Malaysia will announce more changes to comply with the BEPS Pillar 2 in due course. I'm done with my fair share of these slides, and I will pass the next, which is the case studies, which Priya will take over.
Thank you, Prabu. Can we go to the first case study, please? So now that you have a basic understanding of the globe rules, let's just run through a few case studies. So
Yeah, I'm sorry, it does it just by itself.
no problem.
I'm trying to chase the right slide down again, hoping that it will stay.
Okay.
So here we go.
Right, perfect. Okay, so now the first case study we have, it's a very simple one. So before we even look at whether a top-up tax applies under the globe rules or not, we would first need to determine whether there will even be an exposure to BEPS Pillar 2 and whether the globe rules will apply. And I think going back to Prabu's presentation on the exposure, so what are the steps that we need to go through to determine, whether there is in fact a top-up tax to apply. So going back to that, we now need to first look at whether there is in fact any exposure to BEPS Pillar 2. So in this example, we have MMS Holding in Germany, and MMS Holding has set up companies and a PE in 8 countries. So for the purpose of this example, let's assume that they are all 100% held by MMS Holding. And as mentioned at the beginning of the presentation, we know that an M&E group will be exposed to globe rules if it has, number one, an annual consolidated revenue of at least 750 million euros in at least 2 of the last 4 years. And number 2, the M&E group has at least one entity or PE in a location that is not the location of the jurisdiction of the parent entity. So in the year 2025, under this example, MMS Group has consolidated revenue of over 750 million euros. So based on this, and assuming that the consolidated revenue is over 750 million euros for at least 2 of the last 4 years, so then each of the companies and PE within this MMS Group need to submit a globe information return to the respective local tax authorities within 15 months after the year end. So one interesting point to note here is that the threshold of 2 out of the last 4 years does not include the current year. So excluding the current year results from the threshold test will then help the group to ensure that that you will know at the beginning of the tested fiscal year whether you will be subject to the globe rules or not. So this will help an M&E group to plan its resources and then therefore also manage some of its compliance costs. So, but nonetheless, these globe rules are going to give rise to an increase in the compliance functions. So we are likely going to see an increase in compliance costs for taxpayers arising from these rules. Can we go to the next slide, please? So the next case, we look at whether a top-up tax applies to any of the entities within this M&E group. Here we have ACD Holding in Germany. And ACD Holding has subsidiaries in Indonesia, Hong Kong, and Malaysia. And the consolidated revenue of ACD Group is 825 million euros. And it has 3 entities that are not located in the jurisdiction of the ultimate parent entity, which is in Germany. So as mentioned before in the earlier case study, an M&E group will be exposed to globe rules if it meets these conditions. Number 1, the annual consolidated revenue of at least 750 million euros, and at least one entity OPE that is not located in the jurisdiction of the ultimate parent entity. So in this example, the consolidated revenue is 825 million euros. So that's more than 750 million euros. Therefore, the first condition is met. It has 3 subsidiaries, one in Indonesia, one in Hong Kong, and one in Malaysia. So this means effectively that the second condition is also met. Can you click on the next, please? And okay, so the Malaysian company is a manufacturing company that's enjoying a reinvestment allowance, tax incentive. So as a result of that, the effective tax rate for the Malaysian entity is 10%. And the effective tax rate in Indonesia is 20%, and in Hong Kong is 15%. So in this case, would a top-up tax apply? As the effective tax rate in Indonesia and Hong Kong is 20% and 15% respectively, the top-up tax would not apply to Indonesia and the Hong Kong entities. However, since the effective tax rate in Malaysia is 10%, which is lower than the minimum tax rate of 15%, the top-up tax would apply to the Malaysian entity. So what we need to remember here is that what we are looking at is effective tax rate and not the prevailing corporate tax rate. So whilst the corporate tax rate in Malaysia is currently 24%, the effective tax rate in this case is 10% because of the tax incentive that the Malaysian entity is currently enjoying. Next slide. So let's look at another case study here. So in this next case, we now look at the allocation of top-up tax. Here we have A Holding, which holds 60% of shares in BCO. The remaining 40% of shares in BCO is held by third parties. And BCO holds 100% of shares in CCO. CCO is in a low tax jurisdiction. And let's assume for this case that A, B, and CCO are the only constituent entities within the group. Let's also assume in this case that A, B, and CCO are in countries that have implemented the GLOBE rules. So how is the allocation of top-up tax determined? The direct ownership of BCO in CCO we know is 100%. And the indirect ownership of ACO in CCO will be 60% times 100%. So therefore, the inclusion ratio will be 0.6. And let's say that the top-up tax of CCO is 10 million euros. And BCO is a partially owned parent entity because it has an ownership interest in another constituent entity of the group. And 40% of its ownership interest is held by third parties. BCO is required then to apply the income inclusion rule because it's a partially owned parent entity, or POPE, that owns interest in a low tax constituent entity, which is CCO. So then ACO is technically also required to apply the income inclusion rules, IIR, because it is the ultimate parent entity of this MNE group. So the top-up tax that will then be allocated to ACO will be reduced because it has an ownership interest in CCO, which is a low tax constituent entity, through BCO, which is a partially owned parent entity. The reduction of the top-up tax, which is the IRR offset here, is limited to the portion of the top-up tax that has been allocated to ACO and brought into charge by BCO as the partially owned parent entity. So therefore, in this example, BCO will be required to apply the income inclusion rule and has an allocable share of the top-up tax of 10 million euros. ACO is also technically required to apply the income inclusion rule, but its allocable share of top-up tax of the 6 million euros is reduced to 0 by the top-up tax that is brought to charge by BCO. So effectively, there should not be any double taxation of the top-up tax. Next slide. So now, having looked at some of these examples, it would be important to understand what is the direct impact of these BEPS Pillar 2 rules to your business. So the introduction of these global rules will likely see an increase in the tax payable. The OECD estimates that BEPS Pillar 2 will result in an additional annual tax revenue of $150 billion US. I mean, the primary objective of Pillar 2 is to impose a 15% minimum tax rate on earnings by large MNEs. So by doing so through an income inclusion rule and undertax payment rule, the income that is taxed at less than 15% will be a target for additional tax. So this will definitely directly result in additional tax payable. The implementation of these global rules will also likely see an increase in tax compliance costs for MNEs. Whilst BEPS Pillar 2 is targeted largely to large and highly profitable MNE groups and large MNEs with low effective tax rates, with the introduction of several scope restrictions, BEPS Pillar 2 will also likely generally increase the overall tax compliance costs of MNE groups. So, I mean, regardless if you fall within the scope or not, there will be increased compliance costs, because even if you may currently fall below outside of the scope, it is still important to monitor in case at one point in the future that you do fall within the scope of BEPS Pillar 2. So this compliance with these new rules will likely be challenging and costly to taxpayers. So there will definitely be a need to ensure that relevant data is available in real time. And you will also likely need to review and you may require new systems within your group to ensure that this can be properly implemented. Next slide. So the introduction of BEPS Pillar 2 will also see some other kind of indirect impact on corporations. The first we look at is possible relocation or additional investments away from low tax jurisdictions. So there will potentially be an increase in no choice investment costs. There would be an increase in investment costs driven largely by Pillar 2 that will affect MNEs that would otherwise have realized a low effective tax rate. MNEs that have a low effective tax rate will likely have to respond by either decreasing investment or relocating certain investments without any further commercial considerations. In Malaysia, for example, the introduction of the minimum effective tax rate at 15% may deter corporations to invest in Malaysia. So whilst the corporate tax rate in Malaysia is currently at 24%, the many tax incentives on offer in Malaysia could potentially reduce the effective tax rate of a company that enjoying such tax incentives could be lower than 15%. As Prabu mentioned earlier, the Malaysian authorities are already reviewing the available tax incentives in Malaysia. So this will likely change the tax landscape in Malaysia in the near future. We can already see that the Malaysian authorities are adapting the tax incentive framework to a more limited and cost-efficient use of investment tax incentives that will still be seen to maintain the attractiveness of Malaysia to foreign investment. And compliance with BEPS Pillar 2, as mentioned previously, the compliance costs are likely to be increased with the introduction of BEPS Pillar 2. So to ensure compliance with Pillar 2, MNEs will need to be able to calculate the jurisdictional top-up tax in each country where they operate and allocate any top-up tax amount. Complying with BEPS Pillar 2 will be inherently complicated for many groups. The rules are complex at this stage. There is still a lot of clarity that needs to be sought, and it needs to accommodate a diverse range of tax systems without taking into consideration the multilateral instruments to apply the tax treaty rules. It will also then be up to the countries to adopt BEPS Pillar 2 in accordance with the country's own policies and legislation. So we are then likely to see more added complexity in this regard. So it's a space to watch and to observe carefully how this develops as countries implement this within their policies and legislation. Next slide. So finally, what does this mean for you as a taxpayer, and what do you need to be aware of moving forward? So the first would be to determine whether the GLOBE rules apply to you as an MNE. Assess whether the 750 million euro threshold test is passed. If not, then generally the GLOBE rules should not apply to you. So next, assess the effective tax rates for entities within your group. Carry out an exercise to determine the effective tax rate of the entities within the group. Make a preliminary calculation of the jurisdictional top-up tax in each relevant jurisdiction and identify the quantum that needs to be allocated to each one. If the group falls within the scope of the GLOBE rules and a top-up tax is anticipated, consider if it's possible to restructure the business operating model. A restructuring or reallocation of an MNE's functions could potentially increase the efficiency of the group as a whole. So the introduction of Pillar 2 will force MNEs to start to make decisions more based on commercial drivers as opposed to being mainly based on tax drivers. So it's also important then to determine which jurisdictions will enforce BEPS Pillar 2 when making investment decisions. So of course, the possibility of uneven implementation by the different jurisdictions will be challenging. So it's important to keep abreast of the updates on Pillar 2 as they arise so that any changes within the group can be implemented properly. And finally, moving forward, BEPS Pillar 2 should be included as a key consideration when planning for future investments and transactions. So BEPS Pillar 2 will see major changes to the already fast evolving tax landscape. Pillar 2 will bring forth increased challenges with increased tax calculations and tax compliance costs. So whilst at this initial stage, the increased compliance costs can be seen as a burden to taxpayers, that could also potentially be an upside whereby the potential relook at the entire group structure and its operating business model could bring forth added efficiencies and cost savings for an MNE group. So with that, that ends our presentation. I will pass it on to Bettina to run through any Q&A.
Thank you, Priya, and thank you, Prabu, for your presentation and your insight into this very, very complex tax regulation system. And we will see where it takes us in the future. And of course, there are questions to this topic. So I'd like to start with this one. If your head office falls under Pillar 1, do subsidiary companies locally have to be concerned with Pillar 2?
Sorry, can you repeat that, Bettina?
Yes, of course. Just a second. So, first question is, if your head office falls under Pillar 1, do subsidiary companies locally have to be concerned with Pillar 2?
Yes, the short answer is yes.
The short answer is yes.
Yeah.
That's a very clear and concise answer.
Yes, because Pillar 2 and Pillar 1 and Pillar 2 applies it doesn't apply together, it applies individually, but it doesn't exclude Pillar 1 for the application of Pillar 2. Okay,
fine. I hope that answers the question. Otherwise, just feel free to come back to us and we will be happy to go into more details bilaterally. So moving forward to the next question, are countries required to adopt the global minimum tax rules? And what happens if they don't?
Okay, I can take this one.
Yeah.
I can take this one. So the global minimum tax rules are currently not mandatory, but they are agreed as a common approach under the OECD. So this means that jurisdictions are not mandated to adopt the GLOBE rules. But if they choose to do so, they then agree on a method to implement and administer them in a way that is consistent with the agreed outcomes set under those rules. So even if they don't implement the rules, an agreement on the common approach means that one jurisdiction accepts the application of the GLOBE rules by another in respect of MNEs operating in its jurisdiction.
Thank you very much. Do the global minimum tax rules provide any allowance for losses incurred in a period prior to the introduction of the rules?
I'll take this one. So the GLOBE rules provide a transitional rule to take into account losses that have been incurred prior to the effective date of this implementation of these rules. Now, to the extent MNEs have tax attributes resulting from tax losses reflected in their financial accounts, such attributes may generally be carried forward into the global minimum tax regime and may be used in future years to offset the income. This ensures that inappropriate outcomes do not occur, whereby minimum tax is charged simply because MNE is using an attribute that arose as a result of a prior year tax loss to the effective date of the global minimum tax rules.
Thank you very much. And I have one more left to take. So what are the expected administrative and compliance costs resulting from the introduction of the global minimum tax rules? If there is a general answer to this.
Yes, so some of the expected administrative and compliance costs that you would probably see would be you would probably need to update your systems. So for example, your ERP systems, there needs to be data mining in terms of how the group operations are structured and to get information in real time or in advance actually. But the GLOBE rules are also designed to not unnecessarily increase compliance costs and administrative measures for MNEs. So it has been actually designed with the objective of minimizing cost and complexity for both the authorities and also the taxpayers as well. So one of the drive for simplicity is using a number of choices, so including using the country-by-country report, thresholds and definitions for determining the scope, and also the reliance of entity-level financial information and the use of parent financial accounting standards. And then also using deferred tax accounting to address timing differences, having the de minimis thresholds, so certain other measures to manage the compliance costs for taxpayers, also for tax authorities as well.
Thank you very much. And here I have another one just freshly coming in. Is there a threshold for ownership percentage?
Well, there are certain rules with regard to ownership percentage, but in general, it is, Prabu, correct me if I'm wrong, but I think it's 60%. Am I right?
Yeah, that's right.
In general, it's 60%. And this also includes indirect ownership as well. So if we go back to the case study, yeah, so if we go back to this case, sorry, the next case study.
Sorry, yeah, I was moving too quick.
So if we go back to this case study, we would need to include all of them because there is at least 60% ownership by C co of A co. So yeah, that would be the general rule. But there are specific rules and other exclusions as well, depending on the particular structure.
So
it's not such a straightforward question to answer. Thank you.
I'm sorry, but our audience is really very active, and here's one more question that has just been coming in. Going into more detail, I don't know if you can take that at once. Otherwise, we will of course come back bilaterally and clarify any open points. But I'll just take it in. If local subsidiary companies' tax computation is a fairly simple one, does it mean it can generally use the effective tax rate computation as a rough guide if it is above or below the minimum 15% rate?
I think you can. If it's generally straightforward, you can use that as a buffer or some kind of like a gauge to see where you fall in that minimum effective tax rate threshold. However, the rules to compute the GLOBE income or loss for each entity it's fairly complicated to first understand. But I think after you understand it, it would be easier to apply. And the rules, like I said, the rules are not determined in parallel with the application of the domestic tax law. So for now, all you can do now is actually to just use that fairly straightforward tax computation and see where you fall in this Pillar 2 requirement.
So at least to give you a first rough guide on what to expect.
Absolutely,
Fine.
yeah.
Thank you very much. And I think we're just on point with our questions. There's nothing else coming in for the moment. So should anybody of the audience just come up with a question later on, of course, feel free to drop us an email and we will be happy to answer your questions below and above our session here. So for the time being, thank you very much. Thank you very much, Priya. Thank you very much, Prabu, for your very detailed insight into this complex issue and still to be determined in some points. Thank you very much, everybody, for participating and being such an active audience and coming up to us with so many questions, which are great. And of course, if there's anything else, just feel free to contact us. The session has been recorded and can be reviewed anytime you wish. And of course, if you would like to have our slides, I will be happy to share a copy of these with you upon request. Just drop me an email and I will be happy to send you a set of our slides. Thank you very much. Hope to see you soon and have a great day. Bye-bye.
Thank you.
Thank you.